Welcome back, everyone, to my Stock Market Weekly Update series. In this week's episode, we're talking all about earnings because we had some of the biggest companies in the world report this week, including Amazon, Meta, Google, and Apple. And some of them were pretty crazy. There's some interesting stuff in there, and I don't necessarily agree with the way Wall Street is reacting. So definitely want to share with you my opinion on all of that. We're going to run through it, and we'll also run through, as always, the biggest gainers and losers for the week, and I'll mention any additional earnings reports as I run through that list of various stocks as well. So it's going to be a fun one. Timestamps are in the time bar down below in case you need to jump to any specific part. But with that said, hope you enjoy it. Let's jump into it. All right, and starting first here with the markets, it was yet another strong week for stocks, which has really been the case for most of the year now, as the S&P 500 climbed another 1.6% this week, leaving it now up almost 8% year to date, while the tech-heavy Nasdaq continues to rebound even heavier with another 3.5% climb this week, leaving it up almost 15% year to date. And individually, many tech stocks have soared by giant amounts in recent weeks, which is a bit unfortunate for me because I love to buy stocks heavier when they're going down, but I do still think that there are some great deals in the market. I just have to do a little more research and search a little harder to find them now. But that'll turn us over to the market news portion of this video, as all eyes have really been on earnings this week, which the market seems to be loving, but I actually think they were a bit of a mixed bag. Take Amazon, for example, who beat on revenue estimates but heavily missed on EPS with only 3 cents reported versus like 18 expected, while cloud growth also slowed to 20% growth and missed analyst estimates there as well. Even their total sales only climbed by a single-digit percentage, which for the full year, 2022 was actually the lowest growth in the company's history since going public, which is pretty bad. In their earnings report, they also noted that consumers are spending less money than expected because of inflationary pressure as well as rising interest rates that are starting to weigh heavier on consumers, which is also why they gave even lower guidance for the next quarter of only around 5% revenue growth, which also missed estimates. As a result, Amazon stock fell over 8% on Friday alone, but it was already up about the same amount the prior day, so it actually finished the week in the green and is up over 20% year to date. Although from the top, Amazon is still down almost half its value, and I think the stock is still definitely a buy long term. But here in the short term, I think what a lot of investors are missing is that sales for most of these companies are being sort of artificially boosted or being at least held up by inflation rather than organic growth. And the other issue is that inflation with rising interest rates makes it more expensive for these companies to run their operations, which is why profits are tanking and they're having to resort to budget cuts and mass layoffs. Case in point, Amazon alone is now cutting 18,000 workers, while Microsoft is getting rid of 10,000, Meta 11,000, Google 12,000, and there are countless more examples of this with even much smaller companies too, like Shopify, Wayfair, Salesforce, Twitter, Hasbro, IBM, 3M, and the list goes on of just so many companies having so many layoffs and cutting their workforce. So I'm just saying that you guys might want to be just a little cautious here with this very strong market rally that we're going through here to start the year. And look, I know that there are tons of other earnings reports out there that were way better than expected. I know that most of these stocks were heavily beaten down coming into the year, so a rebound off of that is logical. There's nothing wrong with that. But I kind of feel like investors are not paying as much attention to the economy and how much of a mess it's still in, and they're being a little bit distracted by earnings season, whereas a lot of these companies are still laying off a lot of people, they're cutting budgets by huge amounts, and they're advertising way less than before, which are things that can impact the economy and slow it down. So a recession is still definitely not off the table, and even though things might be a little bit better than we thought, there may still be a lot of volatility coming here throughout this year in the stock market. And that's okay though. As a long-term investor, I actually want there to be a ton of volatility. I like doing the majority of my buying when stock prices are going down. And last year was like heaven. I mean, everything was falling. It was great. I was seeing amazing deals everywhere I looked. Now stock prices are going back up again. Things are not as attractive as they once were. So I hope we get some volatility this year. I would love to pick up some of my favorite companies at the lowest prices possible. Speaking of my favorite companies though, Google also reported this week, and they actually missed on both the top and bottom line, with sales only barely climbing by 1% year over year, which was driven in large part by a crash in their advertising sales, especially on YouTube, where ad sales plummeted by almost 8% year over year. And I can definitely attest to that because my YouTube ad revenue is horrible right now, too. And the CEO mentioned that it's because of companies spending less on advertising in this struggling economy, with even their high growth cloud business missing analyst estimates as well. They're also expecting over a $2 billion charge related to the 12,000 layoffs, and they mentioned that more charges will likely come in the future. So, just a horrible earnings report for Google overall, and that sent the stock falling by over 3% on Friday. But just like Amazon, it was already up prior to that and actually finished the week in the green, which is pretty crazy considering how bad that earnings was. Year to date, it's also up close to 20%, but from the top, Google is still down about a third of its value, and I continue to think that this is arguably the best overall stock to buy in the market right now at a PEG ratio that is almost 10% cheaper than the sector, despite how large and dominant they are, with still a lot of future potential. No way that they should be trading cheaper than the sector, in my opinion. We also had Facebook and Instagram parent company Meta report earnings this week too, though, which happens to be a stock that I've been buying over the past year as well, and their stock skyrocketed by over 20% for the week after beating analyst estimates on both the top and bottom line in what was likely a major short squeeze on the stock because they had been beaten down so heavily already, which I'll show you in just a second. But they reported sales of over 32 billion versus 31.5 billion expected, and yeah, as impressive as that is, it was actually a decline though of 4% year over year. And not just that, but it was also the third quarter in a row of declining sales, while their costs and expenses soared by 22% up to over $25 billion, which is massive. Now, daily active users beat at over 2 billion, and even though monthly users missed, it was still almost 3 billion, which is a mind-blowing amount of people using your products, which they also beat on average revenue per each of those users as well. So they're doing a good job of monetizing them. And investors are really focusing on what CEO Mark Zuckerberg also had to say about the coming year, with guidance that could potentially break the decline streak next quarter if sales come in at the high end of their range, which he also described 2023 as the year of efficiency, which of course includes laying off those 11,000 workers while also reducing CapEx spending. On top of that, though, they also announced another mind-blowing stock buyback program worth $40 billion, despite them already buying close to $30 billion last year alone. So in other words, Meta thinks that the stock is super cheap and they continue to buy up their own shares. Like I said, I've been buying the stock myself too, as even after this week's climb of over 20% and being up over 50% year to date, the stock is still down over half its value from the top. I'm probably going to pause my buying for now though, as the PEG ratio has now climbed from less than 1 to above 3, which is no longer the steal that, I used to think it was before this rally. And finally, we also had Apple report earnings, which I also happen to own a bit of this stock too. And in my opinion, this report was also pretty bad. Not only did they miss on both the top and bottom line, but they also reported a 5% revenue drop, which is the largest decline since 2016, noting production and supply chain issues from China, as well as the poor macroeconomy and weaker demand coming out of the pandemic, which CEO Tim Cook also mentioned that they're hearing the same type of challenges from other companies across the market as well. Despite it though, Apple stock actually went up, which I'll show you in just a second, due to optimism that the next quarter won't be as bad. But I actually think that's ridiculous because as far as I can tell, the next quarter is looking pretty bad too. First of all, this quarter was horrendous, with EPS missing estimates and plunging over 10%, revenue also missing and falling over 5%, iPhone sales also missing and falling over 8%, Mac sales also missing and falling close to 30%, and other products revenue also missing and falling over 8% as well. The only things that didn't fall were iPad sales, which were up almost 30% because of new iPads that were released, and then services revenue revenue also rose 6%, which is usually where they get the majority of their consistent growth. And look, I for sure understand that Apple is cyclical with their business. You can see that on this chart here. And there are also some positives to note here, like the fact that they reported over 2 billion active devices now, which they can sell more high margin services to, and that'll help their profitability get even stronger long term. And Apple is a beast when it comes to profits. But to say that the next quarter will be good, I mean, that's a little far fetched in my opinion, because management said that revenue will still continue a similar declining trend. So right now is a down period for Apple. And yet, despite all that, the stock actually rose over 5% this week and is up almost 20% year to date. And unlike the other stocks that are still down giant amounts from their top, well, Apple is still trading like not that far away from an all-time high. So look, again, I love Apple stock long term. I think they're very large, dominant, very profitable, and I think they'll be fine. So I'm holding my shares, but I don't really agree with the recent climb, especially considering that Apple is the most valued stock in the entire world at a market cap well above $2 trillion. So at these levels, I'd much rather be buying Google and Amazon stock, who I think are both still trading at amazing deals. With all of that said though, we also had a ton of other stocks reporting earnings this week. So let's finish up the video now with the biggest gainers and losers for the week. We're running a little low on time, so I'm just gonna do a rapid fire as we run through these individual stocks, and I'll mention any earnings reports that kind of stick out to me as we run through the list, but we'll do it very quickly. Okay, let's do that now. Okay, and starting first here with the biggest gainers, of course Meta made the list at over a 22% climb, we already talked about that, but it was actually Peloton who saw the biggest gains of all, climbing almost 30% this week after reporting better than expected earnings. They're the company that makes those stationary bicycles for exercise, which was a high growth trend during the pandemic, but coming out of it, their sales actually declined last year and posted almost as large of losses as they even did in sales. I've never been too interested in this stock myself, but let me know what you guys think about it down below. One spec stock that I do actually own myself though is the fintech SoFi, who soared over 25% this week after also beating estimates, and I like owning this one long term as they're a great all-in-one platform for everything finance related, including saving, lending, investing, and a lot more. They're also high growth, and in the earnings report, they said that they expect to finally reach profitability by the end of this year. The stock is now up over 60% year to date. However, it is still down quite a lot from the top, at over a 70% crash. Let me know what you guys think about this one and if you own it as well down below. Okay, now there were also a few other popular stocks that climbed, including the music streamer Spotify at over an 18% jump, and the online braces maker Align Technology at close to a 30% climb as well. Both companies beat earnings, and while Spotify continues to be unprofitable and lost almost $300 million this last quarter alone because of all the investments that they're making to bring on podcasts and different exclusivity deals, which they're trying to mitigate by laying off 6% of their workforce. Well, Align Technologies, on the other hand, they're actually profitable. However, at a PEG ratio above 6, the stock has always been a bit too rich for my blood, and that's even after losing more than half its value from the top, even after climbing over 60% this year. I usually get a lot of requests to do a review video on Align Technology stock though, so let me know if you would like to see a review video on them. It seems to be a pretty popular stock. Scrolling down though, we also had a couple popular semiconductor stocks in AMD and Cirrus Logic. They both climbed by almost 15% after beating earnings. AMD in particular is a heavily monitored stock these days after Intel reported such horrible earnings themselves, which spooked the entire semiconductor sector, but AMD actually reported a 16% rise in sales, while Intel had a massive drop of like 40%. However, profits for AMD still crashed by almost 100% in the quarter, and they also gave weak guidance of a 10% revenue decline for the next quarter as well because of the weak macroeconomy and lower demand for chips and computers coming off of the pandemic. So it's not a very good report, I would say, but it was still much better than Intel's recent report. So the stock climbed as a result of that, and it's now up like over 30% year to date, although it is also down close to half its value from the top still. I personally own Nvidia stock and Intel stock, but not AMD. All right, we're running out of time here, so let's just quickly cover the biggest losers. And really, there wasn't too much to talk about this week because, of course, most of the market was up. But we did see a few Chinese stocks make the list, including two that I actually own myself in the e commerce giant Alibaba and the speculative EV company NIO, falling by a double-digit percent each. And that was mostly due to the broader tech sector in China really struggling because of all the lockdowns that have been destroying the economy, as well as the crackdowns by the government on a lot of tech companies too. And all of that together has just caused combined revenue for the internet tech sector to decline by 1% in 2022 after 6 years of experiencing double digit growth. So it was like a very, major difference there. Most of these stocks have actually seen rebounds in 2023 though, so far this year, but are still down massively from the top. Like NIO, for example, it's up about 15% year to date, but is still down over 80% from the top, while Alibaba has climbed over 20% year to date, but is still down 67% from the top and is trading near a decade low. By the way, I do think some of these stocks are a buy, especially Alibaba, because I think restrictions will ease over time and Alibaba will return to growth with an already gigantic and very dominant business. And then I'll just mention that the gaming company EA, Electronic Arts, also fell 11% after weak earnings and a delay of their upcoming Star Wars game. So I may want to look deeper into that one because I always love looking into gaming stocks for any possible deals. Let me know what you guys think of it. But we also had Match Group, who owns dating apps like Tinder, fall about 10% as less people are using dating apps than they were during the lockdowns of the pandemic where they couldn't go out and socialize freely. And then we also had the Chinese e-commerce company JD.com also fell along with other Chinese stocks, as well as one of the big V-shot makers for the pandemic in Moderna, who has seen demand slowly go down for their main product. Anyway, that's going to do it for this week's update. I hope you guys enjoyed it. Sorry for going a little fast here on any of this. I try to keep these videos somewhere around 15 minutes and not too far above that. I don't want the videos to be crazy long and overwhelming, so I have to condense a lot of the information and run through it a little quicker. But I hope you still enjoyed it, and I hope that you're all having a great week. Comment on anything that you want to down below, and we'll have a nice little chat. But I will catch you in the next video. Take care, my friends. Bye-bye.